for electricity transmission. It's a junction where electricity coming in and going out from different states to different states is actually set up. And Techno Electric specializes in some of the high-end substations of power grid as well. And it has its print on more than 50% of power grid substations. Now, in an era where power grid is ramping up with regard to its capex, this particular company comes uniquely or gets placed uniquely in terms of growth going forward on this part of the business. So this is its EPC part of the business. So that's one. Second, so it's a unique play in terms of grid build out, AI play, which is data centers. It does data centers as well. And third is smart metering. Data centers and smart metering are relatively newer businesses for FY26, but the EPC is the more traditional business. So it's going to use those EPC cash flows to fund these two new businesses. And this one trades at sub 20 times FY27 aspirational EPS of rupees 75 a piece. And therefore, it comes at a crucial point where you'll see very, very strong growth. FY26 guided EPS is 50 rupees. FY27 guided EPS is 75 rupees. So a very, very strong growth and a capex cycle which will likely start translating to revenue going into FY27. So this is where we are in terms of the juncture for Techno Electric, and this is why we are finding it interesting. Now, let me take a step back again, try and explain what the company does. First off, the overview. It operates in the power transmission, distribution, smart metering, and data centers business. We've spoken a little bit about this, but I will talk about it a little more in detail. It was incorporated in 2005, and since then, the company has gone from its capital back then to a market cap of 14,500 crores. So we've seen a sharp surge in terms of market cap. Now, let's talk about products and services that it does, break it down individually. EPC power projects, I did speak about that. There's also flue gas desulfurization projects. These are nothing but equipment for flue gas desulfurization. This was introduced as a process in 2015 by the government to reduce pollution for those power plants which are operating on coal. And therefore, the equipment required for FGD, which is flue gas desulfurization, is manufactured by Techno Electric, among many other players who also manufacture it, Thermax, L&T, and the like, and BHEL as well, by the way. So, but the timelines for those are 2027 and 2028 now, going forward. So you've got now 2 years for a lot of these power plants to implement this fully. Second, the third, is competitive bidding on transmission assets, and this is tariff-based competitive bidding. Which is nothing but you set up the transmission line, and thereafter you earn a 35-year tariff on the transmission line. Now, what Techno Electric does is they do not want to earn tariffs on it. What they do is they set it up in terms of the transmission line because they do have the expertise for that. They do it for the likes of Power Grid, but now they're doing it under TBCB as well. So what they do is they set it up and thereafter they sell it to the likes of an IndiGrid. And they've proven this model over the last few years by selling these assets to IndiGrid. So they don't hold the assets on the balance sheet. They don't wait for the 30 years to monetize. They enjoy equity upside, plus they enjoy the EPC contract itself, which is the tariff-based competitive bidding, which they do. And then they sell it off to IndiGrid, who then earns a fixed tariff for the number of years that it holds the asset for. So that's the third part of the business. The fourth part of the business is the advanced smart metering business that they do, where they have installed around 1 million smart meters already. They have a contract for 2.24 million smart meters. So there is some growth which will come through over there. And then there's hyperscale and edge data center infrastructure. Let me explain that in just a minute. What are hyperscale? They are extremely large data centers. They're not generally located in the city. They're located slightly away from the city. And edge data centers are actually located in the city. Now, those are much smaller, more concentrated for quicker data access. And the hyperscale is for large organizations, the likes of an Amazon, which sit on very large land parcels and therefore require larger capex. The edge data centers are going to be done through a tie-up with RailTel, which has land available in around cities, and they will do a revenue share with RailTel for that. So you've got all of these levers through which Techno Electric is seeing its next 2 to 3 years in terms of the leg of growth. Now, in terms of the business model, let me quickly, I've already given you a quick brief, but basically they win large power and digital infra projects. They win those, it comes on their books, it sits as their order book, and we will speak about that. Then they construct for utilities and infra, especially with regard to transmission infrastructure, and the margins are generally already fixed. So it's a very fixed margin kind of business. Around 14 to 15% is what they make in terms of margins. Revenue is milestone based, so revenue gets clocked as per milestones. Costs of material, equipment, labor are broadly the costs which are included or involved. With regard to the TBCB projects, I did speak, they win the projects, they execute, and then they sell it off generally. That has been the modus operandi. And then you have the smart metering business, which is annuity based. You have data center business, which is again annuity based. And they plan to set up 250 megawatt of data center, and each megawatt gives them 8 to 10 crore of annual revenue. So that can be a revenue potential of nearly 2,000 to 2,500 crore going forward. So that's a space, or that's the long and short of it. In terms of customers, especially in the EPC business, there's Power Grid, Adani Energy Solutions, state utilities, there's Nepal Millennium Challenge Authority, which is the Nepal utility, and then there's smart metering companies. Let me talk to you about the revenue split. 99% of the revenue sits out of India, just 1% is exports, and the geography split also EPC, this is the revenue split in terms of business. EPC is 99%, 1% is others. This is FY25, by the way, the previous slide. The geography split is India 99%, export is 1%. Now let me talk to you about the financial metrics, quickly take you through it. The last 3 years in terms of top line, you've seen a very sharp growth, especially over the last couple of years, and that gets you to a revenue CAGR, 3-year revenue CAGR of 31%, no concerns in terms of growth, plus there are plenty of levers going forward as well. In fact, the trailing 12-month revenue stands at above 3,000 crores, so you've seen very strong growth on that base as well. That's something you want to note. The second piece is with regard to the EBITDA. EBITDA has also moved up in sharp proportion, 29% growth on the EBITDA. When you're looking at profitability as well, you've seen a 17% growth in terms of profitability because revenue has grown much faster than EBITDA. So that's broadly, and plus you've got depreciation, which has also come through. So that's broadly the way in which things have moved. In terms of the 9-month period, you've seen extremely robust growth, 54% on top line, 55% on EBITDA, 25% on profit after tax, and you've seen margin expand by around 8 bips thereabouts. Now, let me talk to you a little bit also about the margin trajectory. And margins were traditionally higher because they had better EPC contracts, which were wind-based, and there the margins were far better. Now, the nature of the EPC contract broadly is a 14.5% odd margin which they make, and therefore you largely see the EPC margins in around the 14 to 15% mark. That is the expectation, and that is the management commentary. Let's talk about the order book now. You look at the order book, it was extremely high versus the execution rate. The order book has remained flat, but execution has gone up, and therefore what you've seen is a book-to-bill currently of around 3 times at this point, the trailing 12-month revenue, which you can see on your screen. Earlier it was around 4 times, it's come down to 3.13 times. That's what you can see on your screen. Let me talk about the balance sheet. This is critical because when a company is doing such a large capex and pivoting in such a big fashion, you want a clean balance sheet, and that's exactly what you're getting here. 4,000 crore in terms of book value at this point. There's very little to no borrowing at all on the balance sheet. And mind you, it's a 14,500 crore market cap. We spoke about that. What you're also seeing is a cash and bank balance of around 150 crores sitting in liquid funds. This is part of the fundraise that they had done a couple of years back. Let me also talk about the cash flow now. The cash flow conversion is very decent. Of course, it can be choppy. There were some working capital requirements in FY24, which is why he had a negative cash flow over there. Around 300 crore of working capital requirements there went up. and as a result, that was choppy. But other than that, you've seen very good cash flow conversion from EBITDA. So no concerns in terms of cash flow conversion either. So looking at return ratios now on your screen, the return ratios have been very healthy, except FY23, where we saw a dip. Return ratios have bounced back. Mind you, what will determine return ratios going forward is the data center business, the smart metering business. What's the kind of return ratios over there? And we'll quiz management. Ankit Saraiya will join us in just a minute. He's the CEO, and he'll give us a perspective of this. In terms of ownership, 57% promoter owned, no concerns here. Again, a thumbs up. FIs have an ownership. DIs also seem to like the stock. A quarter of the stock is held by DIs. And then there's public, which holds approximately 12%. Analysts, not too many of them tracking it, just 5 analysts, 4 buy calls, 1 sell call, and a return potential of 26%. We are cautious only from a perspective that there are very few analysts tracking this one. So that's the only reason, but that's generally the case with companies of this size. So nothing too jarring or nothing to be too worried about, but we're neutral from a cautious standpoint. In terms of the valuations, and this is where it starts to get critical. It trades at a 1-year forward multiple of 21 times. Sub 20 times if I look at it, FY27 guided, okay? The 2-year average is around 32 times. The 2-year range is between 16 times to 50 times. We've seen a correction in January. We saw a correction in March, which was in line with the market correction as well, at least for the month of March. And thereafter, we've seen a bit of a lift on the stock price since that point. So this is broad brush the way in which valuations have moved. Now, let me bring on board Ankit Saraiya, Director and CEO at Techno Electric, joining us this afternoon to give us a perspective of how the business is evolving going forward. Ankit, great having you. Let me first start off, let me go segment-wise actually. Let me first go to EPC because that's your core cash cow. How is order traction building up over there? This book-to-bill of 3 times, is that a 2 or a 3-year low or a multi-year low, if I can call it that? Are you comfortable with this? Would you like to win more orders? Are there better orders in the pipeline coming through? Give us a sense.
No, sure. First, thank you for having me on your show. And
very good having you, Ankit.
Thank you. And just to give you a perspective, the industry is looking stronger, brighter, and better with every passing day. I think it has become very, very important, and it has come under consideration that as a country, we need to be self-sufficient when it comes to energy, which is fed by the oil and gas or power. And therefore, we believe that the industry is only going to grow furthermore as importance of becoming self-sufficient in power gains traction. And we see more programs being rolled out in power infrastructure, and we also see a lot more capex getting concentrated towards power infrastructure. So growth is there, pretty much available in the market for one to absorb. I think for any EPC company, what's important is that to grow its management bandwidth and take on projects only up to the extent that one can deliver. And therefore, in Techno, we are quite conscious of that fact. And therefore, we have been growing our order book to the extent that we believe we can deliver profitably. So therefore, the order book for the last 2 years seems to be at 10,000 crore levels. This year, we expect to win around 4,000 crores of order for FY25, for FY26, and maintain an order book of 10,000 crore plus. Execution has been healthy. We've executed roughly about 2,200 crores until 9 months. And we expect that in this quarter, we would have executed another 1,000 crores.
Wow, that's extremely strong. And where do you go from here in terms of execution on the EPC business? What does FY27-28 look like on that 3,200 crore base?
I think we should see a growth of at least 25% year on year. And we should possibly end FY27 with a 25% growth.
And with a 14 to 15% margin?
I would say margins around 14% because there has been an impact on the cost of supply chain due to various geopolitical factors and other aluminum and copper, they're all-time high. So there is an impact on the cost of goods, And therefore, we expect anywhere around 13.5, 14% of margin.
Right, Ankit. And how much of this cost do you pass through, and how much, based on contracts, how much of it do you absorb yourself? Can you give us some color or texture around that?
See, most contracts nowadays do not have pass-through within them. The cost has to be absorbed. As more projects are being won under TBCB model by most transmission developers, the pass-through mechanisms are not available anymore. They largely have to be absorbed. But you see the growth in the business, the 20-25% growth that we are seeing year on year over the last 2 years has also brought in economies of scale. And that has helped us make our operations more efficient. So whatever has been the increase in cost, we are able to absorb it within our efficiency of operations.
Right. Ankit, I'll come to the coolest part of your business, if I can call it that, the data center, right?
Sure.
I mean, that's really the theme, the buzzword. Talk to us about how execution is playing out over there. You've got around 52 megawatts of data centers, one in Noida, one in Chennai, if I've understood it right, which are already on stream. How much of that is already occupied? What is the occupancy rate looking like? What are the early signs signaling to you? And how do you scale that up?
Sure. So I would break this business into two. One is our large format data centers, regional data centers, or one can say hyperscale data centers, and one is edge. So talking about hyperscale data centers or large format data centers, we commissioned our first project in Chennai with available capacity to lease out around 5.6 megawatt in November 25. And within, you can say, 5 months, we've been able to lease out around half a megawatt of capacity. One needs to appreciate the fact that Techno Electric is largely an EPC and not coming from the data center IT industry background. So it is taking us time to build our sales, marketing, and operations capability for a data center. But having said that, the last 5 months has given us a lot of confidence, having leased out half a megawatt as a new player in an industry which requires a lot of track record. So we have the Chennai operating now. We have half a megawatt of customers there. Apart from that, Noida is under construction as we speak. We'll be commissioning the first 5 megawatt of capacity in Noida, and that's in strategic partnership with RailTel Corporation. And that would be commissioned by March 27. Apart from that, we are also in a strategic partnership with RailTel to develop edge data centers in 102 cities. Out of 102, as of now, we've delivered in 2 cities, which is Gurgaon and Bombay. So Gurgaon, we commissioned in August 2025, and it is fully leased out. And Bombay has got recently commissioned in first week of April, and we expect to lease out the entire capacity within next 3 to 4 months. So those are the plans. And this year, I think our focus will be to develop a lot more products and services that we can offer out of data center, apart from pure co-location. And that would help us take our revenue realization on per megawatt basis from, let's say, if it is 7 to 8 crore per megawatt, we can start expecting 14 to 15 crore per megawatt. So we want to start developing more products and services towards network services and towards more IT services.
Wow, so that'll be a significant ramp up. You spoke about how there has been a niggle with regard to, or some difficulty with regard to getting clients in this space, because it's new to you. Talk to us a little bit about that. Are you now seeing light at the end of the tunnel? Are you starting to convert clients at a faster clip? What's the kind of revenue expectation for FY27? I won't ask FY26.
Sure. So you see, yes, for any new player in data center which requires 99.999% uptime, you need a greater track record for anyone to start believing in you and trusting in you. And I think that will take us some time to build up. But having said that, because of a strong execution history in power and as an EPC, and with 40 years of legacy of Techno Electric, it has always it has helped us to acquire the first set of customers, and now the ball is rolling. We have a very decent funnel of customers ahead. We are hopeful that we'll be able to lease out the first phase of 5.6 megawatt in Chennai uh, before September, and if not September, maximum by December. And we should be starting our construction of second phase by end of this year, and so on and so forth. So things have started to look much brighter than what when we started off 5 months back, and today we have a greater funnel and much more confidence in bringing on customers. As I said, Gurgaon is completely leased out. That is one of our first success, and we are hopeful to lease out Bombay as well. But those are edge, uh, and our partnership with Railtel has really played out well. Both the organizations are equally sized and growing together in the sector and helping each other to move in this industry.
No, excellent. Okay, so you've guided for FY27 revenue of around 4,400 crore. My understanding is you'll clock 4,000 crore from EPC alone. How much of this 4,400 or more now will you clock from data centers? Give us that color.
So we are not today including any numbers from data center. Whatever numbers we are discussing is purely out of our EPC business. If anything comes out of data center, it will be over and above.
Okay, so 4,400 crore is data center plus smart meters, or have you excluded smart meters as well from that?
It's including smart meters. Including smart.
Okay, so it includes. And how much is the smart meter kind of revenue run rate that you're expecting? Because that is stable, right? I mean, that's visible, stable, yeah, and the like.
So we have about 1,000 crores of smart meter projects to still execute. And we are hopeful that in FY27, we should be able to completely execute the remaining 1,000 crores of business that we have from smart meters today. So that would add to the revenue.
Okay. And Ankit, give me a sense. So as you ramp up with regard to data center and as you put out capex, what are the timelines in terms of how quickly do you go towards that 250 megawatt kind of number, which is what the goal is?
Yep. So if you actually look at it, we are already executing 100 megawatt of data centers. The Chennai in total is a capacity of 36 megawatt. The Noida, which we are executing right now, is approximately 10 megawatt. Calcutta is also, we just started construction of Calcutta today with substructure work. That is another capacity of 10 to 12 megawatt. And these edge data centers that we are rolling out with Railtel in all together should at least give us another 30, 40 megawatt of capacity. So if we talk about it, we are already executing projects with the total capacity of at least 70, 80 megawatt conservatively. And this year in FY27, we expect Noida to be live with 5 megawatt. We should be able to start constructing another 5 megawatt in Chennai. And apart from that, we are going to roll out at least 5 more edge data centers in tier 2 cities with Railtel within FY27. We have shortlisted locations. They are tier 2 cities, capital of certain states, and those would be our priority for this year. So we will see addition of at least 6-7 megawatt this year with at least 13 odd megawatt under construction. So by 2030-31, we should ideally have 50-60 megawatt going for ourselves.
Got it. Ankit, very quickly, last piece. What's the capex like? A 30-second answer if possible. And how are you funding it?
So we are today funding it completely internally from our internal accruals and the cash flow that we are generating year on year. And one can expect a capex deployment of close to around 40 CR per megawatt of data centers. And and most of our capex is directed towards building the data center business.
That's an ROE of 25%, if I've understood this right, because 40 crore per megawatt and you roughly make 8 to 10 crore a megawatt. So 20 to 25% is your ROCE on this. That's broadly the way to think of it.
Yeah, that would be where we would target, but conservatively, maybe one should consider 15-16%, I would say.
Sure. Okay. Thank you so much, Ankit. This has been an absolute pleasure. Thank you so much for coming in and speaking with us. Viewers, that's all all the time, unfortunately, that I have on this edition of the show. Thanks so much for tuning in.
In association with SBI, the banker to every Indian truly.